Hi everyone, thanks for joining on the show. Let's talk money, your money with India's leading experts so you make your money work harder and faster for you. We're a phone call away, so send in your questions as you watch the show, and do remember to send your phone numbers on the mail as well. Financial advice, remember, is very personal to your goals, your attitude to money and your risk-taking capabilities. This week, some very basic questions and answers on mutual fund investing and a focus on home loans with India's best-known loan expert, Harsh Rungta. And our other guest, Sumeet Vaid, founder and CEO of Freedom Financial Planner, is on Let's Talk Money TV show for the first time. Sumeet, but a very warm welcome. You've been answering our viewer questions for the longest time online and on our social pages. Thanks a lot, gentlemen. Let's start with a very basic question. Last week we did a mutual fund special and we got this very basic question from Premjeet from Manipur. And he says, what is an SIP? How easily we all use SIP in mutual funds, start the SIP route, but we don't get down to the basics. I said, why not kick off the show with SIP or systematic investment plans? Closely got associated, Sumit, with mutual funds.
Thanks, Manisha, first of all, for getting me on the show. It's a pleasure to be here with you on the show. Very relevant question. It's almost become a generic term these days, especially on these shows and especially for us advisors to say do SIP or do SIP many a time. So it's relevant for us to go back to basics and explain what SIP is. And let's start off by articulating and highlighting one of our core products for savings which has done very well in Indian history, which is recurring deposit of a bank. All of us know what is a recurring deposit of a bank, the way it really works. Recurring deposit answer in mutual fund is known as systematic investment plan. In a systematic investment plan, once you choose your mutual fund or your scheme, you can on a monthly basis keep investing certain amount of money over a long period of time. So there is inherent service benefits. That means money is going directly out of your account. You don't have to issue checks, etc. fresh. The second inherent benefit is rupee cost averaging. That means you are entering in stock market at different points of time at different price levels, which really helps them to get the right kind of average price, which is good for customers. And third but not last, which is very important, is discipline. It has been seen over a period of time when we don't do systematic investment plans, we are not able to really have discipline or approach towards investments. And I think this discipline approach is the most important for long-term wealth creation. So the recurring deposit equivalent in mutual fund is SIP, and best of all, it's a disciplined approach of getting into mutual funds.
And we say there's no other way to invest in mutual funds but systematic investment planning, because it takes away the timing from you. You don't have the headache of timing the market, of worrying whether you've taken the right decision of investing at the right time, a lump sum amount, isn't it, Harsh?
Oh, absolutely. I think the big thing about stock markets, I think this was a lesson that I was taught pretty early on, that the only sure way of making money on the stock markets is to buy cheap and sell costly. But then you never can know when the market is cheap and when the market is costly, and especially obviously for a lay person, keeping track of the market itself is a big issue. And therefore in a systematic investment plan, as Sumit said, I mean, it's essentially very disciplined way of investing, and during times when the markets are low, it ensures that you get more units, and during times when markets are high, it ensures you get lower units. The biggest thing it does is you don't have to worry whether markets are high or low. You begin worrying about that only when you reach towards your goal. Otherwise, I don't think you need to worry. So it takes the timing completely out of the decision. I mean, numerous studies have shown that even if you do a systematic investment plan, you can pick up a fund, you can pick up the index. Even every month, if you invest at the least possible price or if you invest at the highest possible price, the difference over 15 years will not even be 1% per annum. Well, that sounds big. The point is you never will be able to make out the lowest and the highest price, and therefore this benefit of timing is the biggest benefit that you get out of a SIP.
Premjeet, at the beginning of Let's Talk Money, I had carried a dummy's guide to investing in Indian equities, and this through mutual funds. What do? Choose one large cap, one diversified and one aggressive balanced fund each. You can start with a balanced fund if you don't want to take very high risk, but these are the three funds that you must keep. Look at the 3 to 5 year track record, not 1 to 3 years when you're choosing any fund, and the websites to find good funds. ValueResearch.com, MorningstarIndia.com, you've got MutualFundsIndia.com. There are just lots of places. Bin50 is another list which is validated every year. Start a systematic investment plan of whatever amount you're comfortable with, and remember to invest with at least a 5-year horizon or more. This is not, equity mutual funds are not for 1 year, 2 years, 3 years. Must only invest the money you need 5 years or more, and actually let it grow for at least 7 to 8 years. You know, mutual fund investing in equities is absolutely a dummy's job. You give somebody else your money who does careful research. Your rupee is spread over several stocks, not one. So you're not taking the risk of one stock. It's diversified, and more importantly, if you hold on for more than a year, it's completely tax-free. Our caller joining us next is Mr. Praveen Singh. Hi, Mr. Singh. Thank you very much for writing in to us. You know, I looked at your question and I was thinking what a great place you are in. You're just 4 to 5 years away from your professional work. I mean, I know you will retire, but you would probably continue to do something else. Both kids settled. I want to get there very quickly.
Okay, hi Manisha. Very nice for taking up my question.
No, pleasure, sir, pleasure. And the pictures you've sent us, what can I say? I really must say you've got a very charming and very attractive vibe.
She thinks so also.
I'm so glad she's got the confidence. I'm sure you've also played a role. They say that a woman's beauty comes from really the kind of love she gets from her man. Go ahead. What's your question, sir?
Okay, Manisha. First of all, let me congratulate you for this super program of yours.
Thank you, sir. Thanks a lot.
You know, it really pleases me to see that young guys who are in their 20s and 30s are taking early and smart investment advice from your team.
Yes. The profile has been quite young and getting younger, I must say.
Right.
How can we help you?
Now, my case is somewhat different. I'm 56 years of age, have worked 35 years in the healthcare industry.
Okay.
Probably would work for another 2 to 4 years max, as I must then very seriously work on that wall swing which has been suffering. For the past 3 years, I have been reallocating my assets in different classes so that they work well for me post-retirement. Direct equities and equity mutual funds currently make up 28% of the asset basket.
Okay.
Mutual funds being 17% at the moment. I've sent you my details of the mutual fund portfolio. This portfolio has been rejigged last year.
Okay.
And I have already exited 2 sectorial funds, ICICI Prudential Infrastructure Fund and Franklin World Gold Fund,
Right.
and taken the result of that on the chin.
Okay.
Basically, I have a very long-term view, more than 10 years, if not eternity,
Okay.
on my investment in mutual funds.
Right.
Bearing that in mind, I would like to ask whether the current portfolio is a prudent one, and if not, what are the qualitative gaps?
Right.
If really required, I can do it one more time, but I do hate reshuffling the pack too often.
No, fair enough. I think the funds that you've chosen, you've done a very good job of it. We don't see any names which we can straight away say should be out of your portfolio. Sumit?
I completely agree. In fact, it's a beautiful choice of the funds which has been done, sir. So compliments to you. And one more thing which I want to really compliment to you is your clarity in terms of the holding period and your ability to go through the emotional turmoil even when markets are down. Because most of the time we have seen for long-term wealth creation, what is required the most is emotional maturity.
More or less where Praveen is, kids settled and on a very good footing. Look at the portfolio, delightful. Anything that you would like to say?
Oh, absolutely. I do not disagree with what Sumeet said. I mean, you could quibble about a fund or two in this, but broadly, I think these funds are good. I think what you should be looking at, Praveen, really is asset allocation. I mean, so I don't see the overall asset allocation. There doesn't seem to be anything in gold, maybe a small allocation to gold. And I think your portfolio size is large enough. So ideally, I mean, time would run short on a TV program, but I would like to understand what exactly it is that you want to do with your wealth. Because depending on that, I think your portfolio size is large enough to look at even other asset classes. Real estate comes to mind almost immediately. Possibly art. I mean, your size is large enough. If it's also a personal preference, if you are an art lover, for example, maybe a small allocation to art would also be. I think your portfolio is large enough to look at much more asset diversification than just equity and debt.
Right, Mr. Praveen, you actually can look at investments beyond just debt and equity, as Harsh has just outlined. Next up, we've got Venkatesha, 39 years of age, joining us from Rajamundry, Andhra Pradesh. Hi, Venkatesha, go ahead. What would you like us to help you with?
Hello, Manisha. Actually, I would like to ask a question. I have taken a whole life unit linked policy from MetLife in January 2000, and the annual premium is 50,000 rupees.
Okay.
My question is one, whether I should I continue in this policy or exit? And if I have to exit, is it better to take a pure term insurance and invest the remaining amount in a good equity mutual fund for better returns?
I think Venkatesh, you've been watching Let's Talk Money very closely, because in lots of ULIPs, that's the advice we have been giving. But Sumit, you take it first.
Yeah, this is my personal favorite too. I think investing in insurance is wrong English. There's no concept like investing in insurance, and it happens predominantly in India. As soon as you can avoid getting into this mistake, you should do that. I think in your case, it's a very pertinent question, because it's a whole life policy. It's a very long-term policy, so you should try and get out of it as soon as possible. But you have taken it in 2009, and at that time, if I'm right, the regulation used to have 3 years lock-in. So you still have some time to go before you will be able to exit. So do get in touch with the advisor who really advised you on this particular product, or directly with the company to get to know whether you can exit or not. Two more actions which you need to do when you're thinking about it. One, try and figure out what is your human life value for which you need to get a term insurance. And when you try and get a term insurance, try and get an online term insurance, which is one of the cheapest in the industry, because you don't really require much servicing in that. That is one.
Right.
And second, which is very important, is articulating some kind of a financial goal for which you can really plan your mutual fund investment. I think these two steps along with this will be a perfect one for you. And for all those viewers who are watching us, please remember, investing in insurance is wrong English.
Last week, we had spoken about a new global index trade introduced by National Stock Exchange, that's NSE. NSE has started trading on S&P and Dow futures. Both are US market indices and capture the US economy. S&P focuses on the large cap segment of the US market and covers around 75% of the US equities. It is seen as an ideal proxy of the US market. Dow Jones Industrial Average includes 30 most liquid blue chip companies in the US. It also represents around 28% of the float adjusted market cap of the US stock market. The two indices are highly correlated, which makes spread trading between them possible. The best part of these indices being traded on NSE is that you can buy these futures in the Indian currency, which is a rupee, so you're not subjected to RBI's limits on foreign assets or foreign currency risks. So look out for these ticker symbols. S&P 500 for S&P futures, where the contract size is 250 units, and DJIA for Dow Jones Index futures, where the contract size is 25 units. Shakti Patra is joining me for the basics of futures trading. Shakti, we are recommending global indices, but the entire market, if you look at it, it's 90% now in futures and only 10% cash. So great way to hedge your portfolio.
Ideally, Manisha, you should use futures just to hedge your portfolio. I mean, that's what the textbooks would tell you. So if you have a portfolio size of say 10 lakh rupees and you see a bit of volatility in the near term, typically you should be selling Nifty futures in the appropriate ratio, whatever your beta for your portfolio is, in appropriate quantities as a hedge against the market. But again, I mean, you never can stop people from speculating, and a lot of the market is actually uses futures to speculate in the market. So it's a divided field over there. You have a lot of speculators, a lot of day trading in index futures, who are basically traders who are betting on the direction of the market, whether it wants to go up or down. So if you expect the markets to go up, you buy Nifty futures. If you expect the markets to go down, you sell Nifty futures, expecting the market to move in your favor and you pocketing the money. But for a retail investor, ideally Nifty futures, index futures should be seen as a hedging mechanism So if you expect the markets to correct in the near term, but you don't want to sell out of your portfolio, probably you should sell a bit of Nifty futures, so that if the markets actually cools off, your main portfolio is intact, but the losses that you would have notionally made in your portfolio is taken care by the hedging that you have used in Nifty futures.
Shakti Patra, always a pleasure to have you with us on the show, and we will continue to bring this series regularly with Shakti to try and get you a better sense of how to trade in index futures. When we come back, important home loan question: should you go for the fixed interest home loan scheme with inflation not cooling down and rates only going one way? That's up. RBI has raised interest rates yet again, and it seems it might have little choice but to keep doing it till it can really pin down inflation. Housing finance companies and banks are now launching fixed rate schemes to offer some comfort to you for the first 3 years. Supriya, my colleague, elaborates the basics of such a scheme from HDFC.
If ever rising interest rates on home loans are compelling you to push out your home purchase, this new product from India's largest housing finance company, HDFC, may give you some comfort. HDFC has launched a fixed rate home loan product called Fixed First, matching an earlier offering from ICICI Bank and LIC Housing Finance in the battle for market share. The customer gets the benefit of availing a home loan at a fixed interest rates for initial 3 to 5 years, after which interest rate will turn floating. HDFC Fixed First offers home loans at a fixed rate of interest for the first 3 or 5 years of the loan. The current offer of interest rate for the first 3-year loans up to rupees 30 lakhs is 10.75%. But the product becomes quite expensive as your loan amount goes higher. If you need a loan of 75 lakhs, the fixed interest rate for first 3 years will be 11.75%. The Fixed First opportunity is available till 31st October 2011. Do keep in mind, experts now believe that this is perhaps not a very good time to get locked in at higher rates, since the interest rates have come full cycle and are more likely to fall than rise. Back to you.
So Harsh, you know, a month ago I would have said interest rate cycles are probably peaking out and there's no point in getting locked into such schemes. Now even I'm beginning to wonder, should we take something like this just to get that sense of comfort that at least my EMI is not going to keep going up?
So I think it really depends on each person's, if you're extremely risk averse, right, then maybe you should do that and take this 3-year. In fact, a better scheme for that is probably the 1-year scheme that you have from ICICI, right, simply because the fixed rate remains just for a year.
Right.
Whereas in HDFC you have to have a minimum fixed rate for 3 years. The point is, I think maybe interest rates have still some rising to do, left to do, as you said, but it can't be very, very far off, at least the way it looks right now.
So it can't go up too much. We are already peaking.
Over
right?
a period of a year, after a year, I doubt we will continue to see this rise. I mean, there are going to be all kinds of issues if you see further rises on top of the rises that we have already seen.
Right.
So, advice simple: if at all you want this safety, try and take it, because this safety comes with a cost.
Right.
There is a premium that you are paying.
Of course, absolutely.
So
it's more than the floating rate.
It's more than the floating rate. So, if you want to pay that premium, pay it. Please, I would not pay a premium for the 1-year product. That's without a premium on the corresponding floating rate. So, I would go for that. But if you want to be really sure, you want to do a 3-year deal and pay a premium, pay it. Keep in touch with what's happening in the market. Right, know what's happening, switch when the time is right. So I think then the premium is probably justified.
All right, so Harsh's view, very risk averse, take it, otherwise don't. You don't really need to pay that premium. Sarvana Kumar, 25 years, very young, calling us from Chennai with a home loan question. Sarvana, already ready to take your first home, I see.
Yeah, hi Manisha, and good evening to Manisha and panel members.
Hi.
I just have a query regarding home loan.
Okay, go ahead.
As I mentioned in the mail, I'm just 24 years working in Chennai as an IT professional.
Okay.
So I have some 3 to 4 queries regarding home loan.
Okay.
So from RBI there is a frequent increase in base points of reverse repo and repo rates. So once there is the revision of base points, whether the banks will automatically changes the number of years of our loan.
Okay.
So it is better to go with increase in EMI or number of years can be increased as per a bank norm.
Okay.
So this is my first query. So next one is whether the credit card payment dues will have a direct impact in home loans. So if you have any dues in any credit card payment,
Yes.
if from about 2 years back, whether it will be directly affecting the home loans
Okay.
if you are planning to take now.
Mm-hmm.
So the other thing is, if we plan to have any loan and if the bank says that we have to clear the credit history, credit history issues, then is there any process that need to be followed to clear the credit history?
Okay.
So this is the thing. Then no, this is my common query. I just plan to buy a flat of around 35 lakhs in Chennai. So how much the minimum down payment I need to plan and how much EMI it will be required?
Okay, fair enough.
And
So that's a
yeah.
we will just start with your question, Sarvana. We don't have too much time. Harsh, EMI or number of years as the interest rates are going up clearly depends on the payment capacity or repayment capacity that you might have.
So
it's not an
absolutely,
easy answer.
if your budget can take an increased EMI, you should go for an increased EMI. But if your budget can't, then, and if you are young and he is pretty young, so then the option of increasing the tenure exists. But there's just one more option that I think every consumer should look at, and that's my favorite, and that is, please don't pay more than what the market is charging. If you've been a good customer, there is no earthly reason for you to pay interest rate of more than 11%. If you're paying more, shift first and then do all these things about increasing EMI or increasing the tenure. I think the other question that you had was on credit history. Absolutely, your credit history, if you have had a default on credit cards, whether it was 2 years ago, you're going to find it very, very difficult to get a home loan. Because clearly, I think the history is important because it predicts what is likely to happen in the future, and therefore, as they say, our old sins come to revisit us, and therefore any defaults.
But sometimes it haunts you too long for a very small credit card debt that you may not have repaid.
Unfortunately, I think yes, that is true, but you can do certain things to improve. One, passage of time itself improves.
Okay.
So I mean, the credit scoring mechanism takes into fact that an old default has less value than a current good repayment track record. So one is, now maintain a good repayment track record. Even if you don't need a loan, for example, if you take a credit card, a secured credit card, you won't get a unsecured credit card if you have defaulted in the past. You can take a fixed deposit based credit card, use that for only necessary expense, please don't overspend, pay that off on time, right, and that creates a good credit history.
Final question, I think, and this is something which he needs to know. 35 lakh loan, what's the down payment he should prepare for and what's the EMI? Ballpark figure?
So 35 lakhs minimum is 20%, that's RBI regulation. So that means 28 lakhs is the maximum loan.
Okay.
And essentially, to be eligible for a 28 lakh loan, he'll have to have a salary of close to 6 lakhs at least per annum.
Okay.
On a 28 lakh loan, his installment based on today's rates would work out to, for a 20-year loan, would work out to about 29,000-30,000 rupees.
Looks like it's affordable, and yet again, Sarvana, 24 years of age and buying your first house. That's the kind of viewer we want here on Let's Talk Money. Gentlemen, always a pleasure having you.
Thank you.
Sumeet, thanks so much for taking the online queries and first time on the show. Harsh, veteran, and we love to have you. Thanks everybody for watching. The contact details for you to write in to us are flashing on your screens. So do get in touch and we'll do the best job we can with your money. See you again next week.